and you're taking an intangible asset and you're valuing it, and then you're putting an insurance wrap around that value, which says this formerly intangible asset is now essentially tangible because it's got an insurance wrap around it. And if it's tangible, it's collateral. If it's collateral, you can raise funding against it.
Hello and welcome to 11FS FinTech Insider Spotlight. I'm David Brear, the CEO here at 11FS. In this show, we shine a bit of a spotlight on the best and brightest in the tech and financial services industry to know them, their business, and really what they think the future of the industry will look like. On today's Spotlight, we're discussing the scale-up runway. In other words, how long does it take startups to get funding that they really need to succeed? What are the challenges with each round of funding? And where do you even start looking for investors? I mean, you just can't walk around the street and find them, can you? To discuss this, I'm delighted to be joined by Alistair Lester, who is the Global Co-CEO of Aons M&A and Transaction Solutions. Alistair, that's a hell of a job title, but how are you doing today?
Well, if you have to say mergers and acquisitions and transaction solutions, it gets even longer.
Even longer,
right?
yeah.
So, no, I'm great, thank you. Thanks for having me.
You need an even shorter acronym, I think.
Yeah, right. We're good at acronyms.
Very good. On today's show, what we're going to be doing is touching on some of the finding from Aons' Funding Innovation Report, published last year, and discuss what equity funding and more broadly, particularly from Series B onwards, really looks like. So I guess considering your expertise in M&A, hence the acronyms that we struggle with, maybe sort of starting at the end of this. How important is it for businesses to have an exit plan, knowing where they're going?
Yeah, listen, I mean, I think it's critical, right? And there's any number of reports out there and statistics out there you can draw from, but the ones that always stick in my mind are for every firm that raises pre-seed money, only 40% get to Series A, right? Broadly speaking. Only half of those again get to Series B, and then only about another 50-60% of those get to Series C. Now, the interesting thing is when you get to Series C, if you get to Series C, you then have a 1 in 10 chance of doing an exit via an M&A, being acquired, right? And that is a far more common outcome for a lot of scale-ups than the public listing, right? The public listings we read about in the press are genuinely, unicorns,
rare,
right? You just don't see them. They don't happen. So, but then go back and do that maths, right? So you've got a less than 20% chance of getting to Series C. And then when you get there, you've only got a 1 in 10 chance of having an exit via M&A, right? So what does that tell you? Logically, it tells you if you get to Series C and you have an M&A on the table, which of course economically, gives you some sort of reasonable outcome, you should be seriously thinking about it.
Yeah. So is that, I had a conversation with my son the other day about, you've got like 1% of 1% chance of being a professional football player. Is it just building businesses, really successful, globally impactful business? That's hard, right?
Look, it is hard. And I think, I'm an angel investor in lots of startups, right? So I see this. I'm a frustrated entrepreneur working in a big firm, but, I see this backing individuals and scale up businesses at seed stage. And there are any number of reasons why those startups fail, right? And we'll talk a little bit about the structural challenges around raising funding. And it is structural, it's not cyclical. When you've got a structural challenge and a cyclical challenge like you've got at the moment, it's clearly really hard, right? But I think it's, you've got to be very, very clear on the mission, on the purpose. You've got to be determined, right? I mean, founder fatigue is a real thing. Funder fatigue is a real thing, right? And I think, one of my personal investments has just exited. Candidly, it was through M&A, but it wasn't a happy M&A. It was almost a forced M&A. But the alternatives would have been worse, right? So I think founders do need to understand where they're trying to get to. I think there is, of course, that challenge of founders' ego, right? They want to keep going. They want to be that 1% of 1%, the 1% that gets to be the IPO that's on the front page of the Wall Street Journal. But they've got to be realistic about it and make sure they're keeping their options open and exploring those options all the way through the process. Yeah,
it's a difficult one, isn't it? It's like starting a marriage with a prenup. It sounds very sensible, but it's actually quite painful to do, isn't it? But so I guess looking specifically at sort of Series B funding, as you say, I mean, why is that so difficult? And actually, why is as you're saying with the success rates post that, is that influx of cash into an organization at that point a challenge for people?
So I think, one of the things that we've been focused on, which we'll dive into a little bit, is how do we really have people understand the value of the inherent intellectual property of IP-rich businesses in that ecosystem, right? And I think when you get to Series B, you've been on a long journey of raising equity already, right? Seed, and you have a bit of fatigue around the whole equity raising process. You're
Sure.
a bit bruised about how much you're getting diluted, right? And what it's meaning for you personally, and that founder fatigue really kicks in. But that doesn't mean you don't still fundamentally believe in the business. You don't fundamentally believe in the mission and the purpose and everything else. So the question is, why can't we find? And then we'll come back to one of the things in our report. Why can't we find other forms of funding which provide runway capital to these firms at the sort of Series B, Series C stage, without them going through the painful process of having to further dilute, raise equity, be distracted, frankly, from running the business by going on an equity raise exercise, et cetera, right? So I think it's that structural issue, right? Until relatively recently, the only way people could raise money was by raising equity at that stage, right? Yes, you had venture debt, but I'll be controversial and say venture debt, frankly, was wolf in sheep's clothing, right? It was equity dressed up as debt. And I think that's the structural issue. I think you overlay that, particularly in the UK, and you've worked all over the world, with this general apathy among consumer investors, if you want to call them that, to the risk aspects of early stage investing. Something like the Mansion House Compact is a great step forward in terms of raising awareness of the opportunities and the need for early stage investment from pension funds. But actually, that's not necessarily going to be an institutional push, right? Because this is about people's defined contribution pensions, right? And it's you and me who have defined contributions pensions who have the chance to make investment decisions for those pensions. And if you look at countries, I would say, and again, you've worked in places like this, like Canada and Australia, where actually, culturally and pension system wise, they're fairly similar to us, right? The appetite of consumer investors who have their funds held by various pension managers in those countries to deploy investment in early stage businesses is completely different to this country, right? And I think that's a cultural mindset shift we've got to make here.
Yeah, and what do you think is that inhibitor? I mean, because obviously, the sort of investing in the big dream from a US, capital investment, it's a very different mentality there than it is here. What creates that divide other than the sea?
I mean, again, I might be a little controversial, right? So I do think there's a regulatory challenge, right? I think that we encourage, and rightly so, look, we're all about protecting consumers, and people aren't necessarily in the right mindset to pay for returns, right? So there is a fee dynamic, which is going to be complex to solve here, right? If you want higher returns, then you should expect to pay higher fees. But we're in an environment where everyone is very, very focused on lowest cost fees. And for lowest cost fees, you are going to get, vanilla commoditized capital deployment, and which will generate returns, but not the outperformance that, people might expect to see in places like America. And so I think it's an awareness, it's a cultural thing. I mean, we're talking the day after the budget, right? And it was interesting yesterday. It was a relatively small move, but again, another, I think, significant sort of signposting move that this, British ISA move yesterday in the budget. I think that is the sort of thing we've got to do. People have got to become more focused as personal investors on the opportunities here and more confident. And I was at a BVCA, British Venture Capital Association dinner last night, and one of the funds there talked about one of the deals he'd done and how well it had gone, and how he has a lot of pension and university pension endowments as investors in his fund in the UK. And when he did this exit, which was a stellar exit, he was invited by one of the universities to open the library that was going to be built by the proceeds from this deal. So it was an incredibly proud moment, except he said, I was standing in Chicago, not in, Leeds or Manchester or one of the, because that's where the investment had come from, right? So again, it's a mindset shift. He said, I would have loved to be standing in Manchester and seeing a new library being opened in Manchester as a result of the proceeds from the deal being passed back to a Manchester-based pension fund.
Yeah, it's interesting, isn't it? The ecosystem around investment needs to be as strong as the investment potential in itself, isn't it?
Exactly right.
And so much of that is not capital; it's the capability and the mentality, isn't it?
It's mindset, it's regulation, it's all that sort of stuff.
So I guess switching to the people who are getting the investment. I mean, obviously, entrepreneurs go through quite a process in terms of giving up equity in your business and everything that goes with that. What would your advice be to entrepreneurs in that? Because it's as you said, there's an element of grief almost in terms of giving up equity in your business. What would you say to those people?
So look, from our point of view, one of the things we've worked very hard on over the last few years is to try and find a way to bridge the very deep pool of capital that is the insurance industry with the financing ecosystem, right? So in our world, what we're saying to founders who genuinely have IP rich value proposition and IP rich businesses, really understand the value of that intellectual property, right? And most importantly, understand the value of that intellectual property, perhaps independent of the going concern of the business,
Sure.
right? Because what we've been able to do is find a way to have the insurance industry wrap intellectual property in a way that almost guarantees it will be worth something, right?
Sure.
And you're taking an intangible asset and you're valuing it, and then you're putting an insurance wrap around that value, which says this formerly intangible asset is now essentially tangible because it's got an insurance wrap around it. And if it's tangible, it's collateral. If it's collateral, you can raise funding against it, right? So it's an education process for founders to understand what they have in their business, right? Not just what they're trying to achieve, what their mission and their purpose is, but what are they creating in terms of intellectual property that's allowing them to get there? Because that intellectual property is actually the core value of the business potentially, or a core value of the business, not just about free cash flow and run rate ARRs and all those other things. It's about what have you created to enable your mission to come true, and what's the true value of what you've created, which ultimately might not be value for the business that you're using it for at the moment. It could have value applications in other places, right? And then understand that and see if you can get some value out of it, which means you don't have to go and dilute equity because you've got collateral in that value, which you can raise funding against.
And how much of that, because that all makes total sense, doesn't it? And actually, if you stand back with experience, you can go, that's a very rational argument, isn't it? I guess the challenge for most entrepreneurs, and you touched on this a little bit before, is this is their baby. So it's not a rational argument; it's an emotional one, isn't it? And is that a big part of the issue? Because and not like everybody should grow up and be more rational. Actually the sort of blood, sweat, and tears that goes into building a startup is by nature a sort of a trade-off against your life and your time and all of those things that go with it. So nobody starts a business because they understand these things. And definitely in the research we've done, building metal in the UK and all around the world in terms of SMEs is, whether you're starting a business to build banks for people or make cupcakes on the corner, people are very good at knowing that, but they're not very good at running a business, right? My learning curve building 11FS has been, I wouldn't even say it was steep. I'd say it was vertical. You know what I mean? Because you just,
and you're learning every day.
Right? But the challenge is you either really love that challenge or you love the thing that you built it to do. So either you love building a business or you love doing cupcakes, and actually it's a difficult balance between them, isn't it?
And surrounding yourself with other people who counsel you take, and you talked about your chairman, right? I think it's very interesting at some of the seed investment stage. I've been a seed investor in businesses where I have been a completely passive investor, right? And I've been seed investors in businesses where I've been almost an advisor to the founders. And I think you do see a mentality there. I do think, there are founders who want to hear from, don't just want to take money from investors, but want to use their perspectives, leverage their network, leverage their insights. And look, everyone's an individual, but for me, that seems to be a more successful way of doing things rather than holding their baby very close, right? It's, it's being able to step back and say, be proud of what you've invented, be proud of what you've created, but it takes a village, it takes a city to actually make something really come alive.
Definitely, particularly if you want to walk that very narrow rope of, being internationally successful or, being the 1% of the 1% of the 1%, right? So I guess what are you guys doing to support people in that sense? Because we talked a lot around this, but Aon are doing a lot to support businesses. So talk a little bit more about that.
Yeah, listen, the core area I've touched on already is how do we bridge this deep pool of insurance capital, which is very deep, right? And look, the insurance industry, broadly speaking, is also a pool of capital that could be getting deployed in an investment capacity like pension funds I've touched on. But the really exciting thing I think we did was this creation of an insurance product, which we call collateral protection insurance, which is really wrapping the inherent intangible asset value of an intellectual property stack and taking that to investors and using that as collateral, which is then enabling people to raise essentially runway debt capital rather than dilutive equity finance. And it's really intriguing, David, because I'm going to get this wrong, let's say 5 or 6 years ago, the British Business Bank issued a report that said, why doesn't the financing industry recognize the inherent value of intellectual property, intangible assets and intellectual property in the startup community, right? That question is still out there. What I would also tell you is, look, we've enabled something like $2.5 billion of debt financing to flow into the high growth scale up community.
Yeah.
All but one of those transactions has been in the US.
Wow.
Right. We've done one in the UK, and there's more coming. And again, it goes back a little bit to dynamism of community, dynamism of ecosystem. And again, you'll know this better than me. I find it fascinating. You take a very similar business in the US and take it to raise money. You go and ask for $20 million, they'll laugh at you, right? Well, you ask for 20 million, you ask for $200 million, right? And by the way, your value is not 50, it's 500, right? And so the level of ambition, and of course there's huge failures and just as many, failed startups there as there are here, but the level of ambition is greater. And maybe that's part of the secret. But look, Aon is really focused on how do we help founders really understand that inherent intellectual property, intangible asset value of their business, and can we somehow put an insurance wrap around that provides you with collateral, and if you've got collateral, you can raise finance against it, and it avoids equity dilution.
Fantastic. It's an amazing thing, and there's no one answer, is there, in that sense? We talked about various different things of a community and the
spot on. No. I mean, this is what we're doing is a very $2 billion sounds a lot of money. It's a drop in the ocean.
Sure.
Right? We know that, but it's another example of trying to find a contributor to this community to try and solve this structural issue.
It's amazing, isn't it? It feels like the fintech space, the insurtech space, the tech space more broadly, we're not done yet, right? There's so many good ideas out there. There's so many businesses still to be built that can change the world. It's maybe back to your point around aspiration. It's starting with, maybe writing the last chapter rather than the first one, right?
Yeah, I agree with that. And I think what's also interesting is we're seeing, coming back to where we started, we're seeing a real momentum building of large strategics looking to buy small scale up businesses.
Yeah.
Now you have really interesting issues when that happens in M&A, right? You have, and again, we this is another area we as a firm help, but you have big, large global firms buying entrepreneurial small firms, right? And how do you make sure, and really it comes back to intellectual property, how do you make sure you're able to retain the trade secrets, know-how, intellectual property of the individuals you're buying? You take, people who work for you and you put them inside a big management consulting firm, it's going to feel very different, right?
Very quickly,
Benefits, compensation, culture, all of those things. How do you make sure as a big firm when you're trying to make these moves, you don't impose, the big way of doing things on these small firms? And our talent people spend a lot of time working out how compensation packages inside big firms can be bespoke to accommodate startup businesses that are being acquired, things like that, right? And it's just, I think the world's becoming much more conscious about the value of having startup entrepreneurial mindset inside big firms, and rather than imposing, the way of doing it, this is how we do it. It's becoming a much more flexible environment.
Yeah, and that journey's about everybody becoming sort of more aware of how you get to the outcome, isn't it? So, and startups have got a big place to play in that, isn't it? Often a 10-person startup with the right incentives and the right culture can do more than 5,000 people in a big company, can't they?
Exactly, and have a positive impact the other way, right, as well.
Well, I mean, look, I think we could probably talk for another couple of hours on this one, because I think there's so many different dynamics. We'll have to get you back to kind of talk about this as it moves forward. But also, I think as the market changes, we're in a weird place, like you say, in terms of where the market is. And I don't want to use the Brexit word because we've stopped talking about it like it's Voldemort.
Came up at dinner last night. I didn't want to talk about it last night.
Yeah, and all these things are still having an impact on the UK economy, the UK community more broadly. But we'll get you back on and talk about it a little bit more. But thank you very much, Alistair, for joining me. Where can people learn a little bit more about you and all the good work that you're doing at Aon?
The best place is always going to be aon.com. So go to aon.com, look for intellectual property, look for M&A transaction solutions. There's plenty on there.
Fantastic. All right. Well, that's all the time that we have for you this week. Make sure that you follow 11FS on LinkedIn, Twitter, Instagram, pretty much every social media channel at this stage. Do subscribe to the 11FS YouTube channel as well, where you can find all of the previous episodes of this show. Have a great day, everybody. Have a great week. Look forward to seeing you soon. See you later.